Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Microsoft was founded in 1975 by Bill Gates and Paul Allen. They specialize in personal computers, computer software, and various electronic products. Some of their most famous products and services include the Windows software, Microsoft Office, which includes Word and PowerPoint, as well as Excel. They also sell Surface laptops, among many other computers, and they also have the Xbox console brand. Microsoft's operating segments include productivity and business processes, intelligent cloud, and more personal computing. In 2019, their most profitable segment was their Productivity and Business Processes division, which netted them $16.2 billion in profits. Their Productivity and Business Processes division has been growing the quickest for the company, with a 25.4% increase in profits between 2018 and 2019. Microsoft is currently the largest company in America, valued at $1.2 trillion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Microsoft had an earnings of $2.63 per share. In 2015, they followed that up with an earnings of $1.48 per share. This was 43.7% less than 2014. In 2016, their earnings jumped back up to $2.56. This was a 42.2% increase from 2015. In 2017, their earnings jumped again up to $3.25, representing a 27% increase from the previous year. In 2018, their earnings dropped back down to $2.13, which was a 52.6% decrease from the previous year. In 2019, their earnings jumped way up all the way to $5.06 per share. This was a 137.6% growth from the previous year. This data indicates that Microsoft has grown on average 14% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of April 5th, 2020, Microsoft was trading at around $153.83 per share. This represented a PE ratio of approximately 28. This is higher than the trailing 12-month PE ratio of the Standard & Poor's 500 at the time of this recording, which was 18. This indicates that from a PE ratio perspective, Microsoft may be overvalued. In this next slide, I will be talking about the company's price to earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of April 5th, 2020, Microsoft was trading at $153.83 per share. This represents a price to earnings growth ratio of approximately 2, using the current PE ratio and the average growth over the past 5 years. This PEG ratio indicates that Microsoft may be overvalued. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of April 5th, 2020, Microsoft offered a forward dividend yield of 1.3% as they paid 51 cents per share per quarter. Microsoft most recently raised their dividend in November of 2019 when they bumped it up from 46 cents per share to 51 cents per share. Microsoft over the past 5 years has increased their dividend by an average of 9.9% per year. Their dividend payout ratio is currently 43% based on their past 12 months of earnings. This indicates that they can likely sustain this dividend payment. In this next slide, we will be going over the company's price to book ratio as well as its debt to equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of the beginning of the year in 2020, Microsoft had a book value per share of $14.48. This represents a price to book ratio of 10.62. As of January 2020, Microsoft had a debt to equity ratio of 0.64. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Microsoft stock on April 5th of 2017 and you held it for 3 years and reinvested all the dividends you received, you would have seen an annual return of 33.7%. If you had held Microsoft stock for 5 years before this point, you would now be looking at an annual return of 34%. And if you had bought Microsoft stock on April 5th of 2010, held it for 10 years, and reinvested all the dividends, you would have seen an annual return of 19%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. I give Microsoft a B as a defensive investment. They are a large company and they do have quite a bit of cash. I like that they have a relatively low debt to equity ratio. They're overall a pretty good company that I think would withstand an economic downturn. As a growth investment, I love Microsoft. They have a lot of opportunities to grow here in the future. They've introduced some pretty cool things like Microsoft Teams, which is a great productivity tool. Even as the biggest company in the world, I still think they have some room to grow, which is why I like them so much as a growth investment. The technology sector has been on fire in recent years, and I don't see any reason why it will slow down. Overall, I really like Microsoft as a company. They're very profitable. I think they have a great business model, which is why I really do like Microsoft. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.